Hello folks, this is Tony Drake from Drake & Associates with an educational economic update for February 2018. In this month's video, I'll discuss some of the major headlines that influenced markets in January. I'll also provide an insight into what these developments could mean for you as an investor. Now please stay tuned at the end of this video for a required disclosure statement. January 2018 is behind us, and stocks posted quite a positive start to the year. In fact, even anticipation of the first federal government shutdown since 2013 didn't derail the markets. The S&P 500 and the Dow both had their best monthly performance since March of 16, with each rising over 5%. The Nasdaq gained 7.3%, making January the best month since October of 15. Several details that came out during the month indicated a strengthening economy is really driving market performance. Initial readings of gross domestic product, or GDP, showed the economy grew by 2.6% in the fourth quarter. Though smaller than projected, the increase still implies healthy economic growth. Corporate earnings data also suggested that the economy continues to expand. During January, many companies released their earnings reports for the fourth quarter of 2017. By the end of the month, 81% of S&P 500 companies had shared their earnings data and beat expectations, and 83% exceeded their revenue estimates. In addition to growing corporate earnings, labor measures seem to illustrate that the economy is advancing. The ADP employment report indicates that private companies added more jobs in January than analysts expected. Further, few people filed for unemployment in late January, keeping initial claims close to a 45-year low. Unemployment currently sits at 4.1% and may go as low as 3.5% by the end of the year. And wages are finally starting to pick up as well. According to the Labor Department, the Employment Cost Index, ECI, in the fourth quarter was 2.6% higher than a year before. This increase is the largest since early 2015. Examined together, you see a growing market, increasing corporate profits, low unemployment, and rising wages. But this positive news is not without risk. If the tight labor market leads to faster wage growth, inflation could increase. At that point, the Federal Reserve could start raising interest rates more quickly than anticipated. The Fed met at the end of January and decided to keep interest rates the same for now. They did indicate, however, that they expect inflation to increase over the next year. After years of inflation missing the Fed's 2% benchmark, the markets would have to decide how to react to price increases more rapidly. Ultimately, we have strong growth in corporate earnings on one side and the potential for faster than anticipated interest rate increases on the other side. Looking ahead, we'll continue to analyze the interplay between economic growth and inflation. Only time and data will tell exactly how these connected pieces will come together. But we'll definitely work with you to keep you informed along the way. That's it for this month's educational economic update. Please visit us at wealthwisconsin.com to learn more about our upcoming workshops, and be sure to listen to our Retirement Ready radio show on AM 620 WTMJ Saturdays at 1 o'clock. Once again, this is Tony Drake from Drake & Associates, signing off for the month of February 2018. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call. We'd be happy to talk to you.